All right, thanks for having me here tonight. This is the first event out here I've attended, so appreciate the invite.
Awesome.
My name's Adam Gelhausen. I'm the managing partner of a firm in Spokane called Palindrome. I was born and raised in Spokane, went to Rogers High School, and then went to Washington State University. Yeah, I hear some laughs out there. Usually when people find out I went to Rogers, they double check that. I ended up going to Washington State University and had the fortunate opportunity to work for the endowment at the university, which opened some doors for me. And I ended up helping manage that. And then I moved to Boston for about 10 years and worked for one of the largest institutional money management firms in the world. So if you've ever bought a Vanguard fund or a Hartford fund, chances are at some point in the past I had something to do with that fund. I worked in the technology team. We did all the equity research on any tech companies we put in the portfolio. So it was a great opportunity. I worked with some of the smartest people I've ever met in my life, and missed home. So moved back 3,000 miles and, kind of floated around a little bit, did some different projects, and decided I wanted to start an investment firm. And really the impetus for what we do is, and we buy private companies, was that my dad ran a parking garage for 48 years, and we'd always meet all these different small business owners in the area. It always struck me how successful they were, but you never hear about them really. They're kind of under the radar. So we decided, there's a really big opportunity here to look at these companies that have spent 30 years building their business, generating strong cash flow, and they kind of get to a point where they want to hand it off. And if we could work with the right sellers and find opportunities for us to continue the success they had, we can keep these businesses going not only for the benefit of ourselves, but of course for the community and the employees. One thing that's been hard for me in these smaller communities, and we've seen it, is when bigger companies come in and acquire something and then divest it or move it. The best example I can think of is Kimmel Athletics. I got my first T-ball bat at Kimmel Athletics when I was a kid, and a company from Texas bought it, and now there's no more Kimmel Athletics here. They sold the building, the employees went elsewhere, and part of our community kind of gets changed. And so coming from here, I know what it's like coming from a small town that has a strong community based on, some of the organizations that are there. White Elephant's another one. White Elephant, they didn't really shop that around. It just got kind of closed because I don't think there was a real evident buyer. Handing off a business is really difficult. So we decided to start a company that would buy these great companies. And the advantage for us is that we decided to extend and offer benefits to employees that maybe they didn't have under previous ownership, because we can consolidate all these purchases and get some economies of scale. So today we own 5 companies. We don't think of ourselves as offering jobs. We offer careers in what we do. We invest in continuing education for our employees. We invest in full benefits, insurance, 401k plans, and we really try to foster, I would say our number one initiative is culture. So we invest heavily in culture across our organizations, and we try to support people and give them the tools they need to succeed and help us, take us to the next level. So that's in a nutshell what we do.
That's awesome. That's really that's amazing. Let's give him a hand. I love it. Yeah, that's amazing what you've been able to accomplish. Any one part of that would be impressive for most people. So that's very, very impressive. Can you tell us a little bit about what drew you to, or how you even got to the point where you were ready to start to consider purchasing a company? So let's walk through, what led up to that first purchase, that acquisition.
Sure. So I was really lucky when I worked in Boston. I worked for a guy that he basically forced me to replicate his MBA over the course of 2 years. So I didn't have to work on real portfolios for the first couple of years. So he took me through a process where I just really got a real great understanding of valuation, how companies work, capital structure, evaluating financial statements, and it became like that's all I did. And I caught a bug where I really liked kind of sleuthing around these company financials. So if you ever looked into a company filing, which I'm pretty nerdy, so I do it a lot, you can find a lot of valuable information on companies, and it's something that I really started to enjoy. The part that was hard on publicly traded companies is, people have started to speculate more as opposed to what I would say traditional investing brought, which was finding value, right? Finding real cash flows. I can't tell you today why Tesla is one of the most valuable companies in the world other than it's popular, because I can't tie it back to the fundamental value that I usually like to identify. So for me, I can't sleep at night if I can't make sense of the numbers. So value is really weaved into my DNA. Private companies offer the ability to buy tangible cash flows and assets and things, and you don't have to worry about press releases or company earnings or Google missed and the stock's off 20% one day or up 40% the next. So being able to kind of rationally understand what it is we own through cash flows was important. But that's kind of the technical aspect. The human side of it, which is even more important to me, was what the catalyst for me to, I guess, buy the small stuff was that there are some great people that have built some phenomenal businesses, and there's no obvious way for them to transition these companies. Some of them just decide to close them. Some of them sell it to the wrong people. And for us, and we don't have a private equity model, I should start with that. A private equity model, for those of you that are familiar, is really predicated on understanding how to sell a company. Because when you buy a company in private equity, as you sign that document, you have to think about how you're going to sell it. And it's usually, look, we're going to downsize the people, we're going to close these lines, we're going to borrow a bunch of money and lever it up. And we're buyers, we're not sellers. So we to this day, I haven't sold a company. We like to buy things, we don't like to sell things. So for me, it was kind of pairing the combination of being from Spokane and meeting some of these wonderful business owners, and then applying kind of the technical skills I learned at the investment firm and kind of smushing those two things together and building a sustainable portfolio based on these companies that, to be quite honest, have done most of the hard work, which is we've managed through up and down markets for the last 30 years. So speculating on something that's never made money just doesn't make sense to me. So investing in kind of a margin of safety is really at our core.
That's awesome. What was your first company purchase?
Yeah, it was a company in Hayden, Idaho. It's on Hayden Avenue. It's called North Idaho Hydro Seeding, if any of you've seen it.
Oh, yeah.
We bought that from a couple, the Leonards. They started so it's funny, actually, when we were figuring out what we're going to call our entity that's going to hold these companies, because we're called Palindrome, which I don't know if all of you know what a palindrome is. It's a word that can be spelled backwards and forwards. We decided to name the fund 1991 Partners. And the reason 1991 is, one, it's a palindrome, and two, most of the companies we're buying operate like it's still 1991. So as we were doing our due diligence, a lot of paper, a lot of Google email addresses and Hotmail. And so when we met the Leonards, they started the company in 1991. So we just knew it was kind of serendipitous. And we are fortunate. It was a very painless acquisition. In fact, when we closed it, the lawyer said, their lawyer said to us, this is the easiest closing I've ever had in my career of 30 years. So we're very picky. We look at 20 deals a week, I would say, and we pass on most of them. We have a couple deals going on right now, but if we can do a couple deals a year, I think we've done a good job. But that was the first deal we did.
That's amazing. I've used them before for lawns for properties I've done with my real estate background. So I love that. That's awesome.
Yeah,
you didn't even know.
Yeah.
Very cool. So if someone's looking to, they're considering the idea of selling a company, what is the process that you would walk them through to kind of, if you were, a friend, a coach, helping them get it ready for somebody to buy it like you? What are some of the things that you would want them to do to prep the company? And both on for two sides. One, obviously, there's some things that we're like, you don't have to do everything because it leaves a little bit of room for us to do the improvement into the business. But there's also some things that are like just obvious, like stop doing that and focus on this. What could you walk through that?
Sure, and actually, if you're interested, it was funny, this is interesting, we just this week posted an article called 10 Things You Should Think About When You're Selling Your Business, because there are questions we always get, things we always see. But I would say, by and large, the number one thing, if I was advising someone to sell their business, is get comfortable with the emotional aspect of it. Before we ever talk about numbers, before we ever talk about a transaction, I sit down and we'll spend the first meeting, maybe two, just talking about the idea that there's a Monday coming in the next couple of years where you won't wake up at 8 a.m. and have to go to an office that you've been at for 30 years. Well, how's it going to feel for you not to go to that desk anymore? And if someone can get through that piece, then we can start talking about the easier piece, which is the transaction. But I really try to spend a lot of time on the emotional aspect. And, our specific focus is to really find that amicable transaction. I tell sellers that we try to do a deal where I can call you in 5 years and you can tell me exactly what I'm doing wrong still. We don't do acrimonious deals. We're not hardline business people. We try to do a deal where we can still keep those relationships going, because most of these people, in fact, all of them, have forgotten more about these industries than we'll ever learn. So leveraging off of their expertise by doing a deal that allows them to feel like they're still involved and that the legacy they have is preserved is the number one thing. So that, I would say, of the 10 things, that's probably 50% of the time you spend is on the emotional side. Things we see sometimes that really should be thought through is you wouldn't sell your house with a hole in the roof. You wouldn't sell your house with the deck broken. So make sure that the place is ready to sell. Get your personal junk out of the back, your sleeping bags, your old tents, stuff on the shelves. Make it look presentable. Make sure you spend time with your accountant to clean up the financials so it represents the company correctly and doesn't include a bunch of your personal stuff. You see people where they'll capitalize personal assets in their company balance sheets, and you got to parse those out. So all of those things will help you extract more value out of the company. If it's cleaner, it's just more presentable. It's like a house with fresh flowers in the front. It probably commands a little more of a premium when it looks better. The other things I would say is be patient. It's your company. Control the process. You don't have to sell it to the wrong person. Sometimes some sellers feel like this is the person I have to sell to, or I'm not going to be able to sell it. You're going to sell it. Find the right buyer for it, because what you don't want to happen is the thing you spent your entire career building, you drive by it on a Tuesday in 3 months and it's closed because something went wrong. So assess the competency of the buyers. Understand the valuation and have your expectations in mind. We'll talk to people, their expectations is way off from reality. And some of that's from the stock market, some of that's from the real estate market. But buying a private company is much different than buying a piece of real estate or a stock.
Could you address the valuation side? That's a question that I get constantly. People are asking me, hey, I've got a business and I'm really curious what it would be worth if I were to sell it. And I think there's a lot of different perspectives about that. So I'd love to hear, what do you think is fair when it comes down to it?
I would say
it's a little, I know.
So I would say the lazy shorthand way of doing valuation, and everyone's heard these, is to throw out multiples. Oh, it's selling at 4 times EBITDA, 2.5 times EBITDA, 5 times EBITDA. Everybody uses those. We use them, right? But it's really not the finish. It's the start. That is something that'll give us a starting point, and then you dig into the financials. And I would say the biggest gap between buyers and sellers, if they're not well educated, or I should say well advised, is they don't understand the difference between, my buddy has a business and he sold it for this much and I sold it for this much. Buying a manufacturing company can have a huge working capital component. Most people don't think about working capital, but if you've got your accounts receivable sitting out there for 3 months and you pay your bills every month, you're financing a lot of the company versus a software company where you're, collecting it basically on that day. So understanding the machinations of the company, the valuation, is a critical component, because a multiple alone will not give you the insight you need. And if you're not capitalized to, sustain a 6-month AR or something that goes wrong, and you have to inject more capital in the business, then you're going to shoot yourself in the foot. So I would say on valuation, without getting too technical, sit down with the advisor that's working with you and make sure you understand what's driving your valuation and what's driving your financials. To put it in basic terms, you know how long it takes you to collect money from your customers, and you know how long it takes you to pay your bills. That's going to be a big component of it. But a software company has high margins, so the valuation should be higher because you get a lot of leverage there. A company with low margins is going to generate less cash on a percentage basis, but if it's 3 times the size, the dollar value could be higher. So rather than saying how to approach valuation, I would say just understand what you don't know and spend time going into the details so that you can understand it. So when someone makes you an offer, you're not offended, and you may reject the offer, but make sure it's, you understand how it was done so you're in the ballpark and expectations are managed.
So you had mentioned, I think previously, that a lot of the stuff that you are finding is not listed for sale, or it's not listed on a standard website, and it's maybe not always going through a business broker. My experience with talking direct with people about their companies that haven't involved a business broker or a CPA in the process is that they've got so much emotional equity built into the purchase price that the deals a lot of times don't work. And you had talked a little bit about how you walk through that. Are there any other tips that you could give on how to kind of walk through that process?
Sure. I mean, for us, we think the biggest lead generator for us is going to be reputation, right? I mean, our philosophy on investing is probably a little different than a lot of people's. Most people invest wanting to turn $1 into $1.50. We simply try not to be too dumb. So we try to buy that dollar for 50 cents if we can and protect our downside, because by having our back office and infrastructure there, by having our core tenets in place on our culture and building up a reputation, it's a little easy for us to generate a transaction because we have a process in place that can preserve the company and actually the owners can feel comfortable with. That being said, there are numerous sources for companies. We have people working at some of our companies that know someone they want us to talk to. So we'll get emails from people, or we'll go talk to people directly. Brokerage listings are a fine place to start. We start, like I would say, half the deals we look at come from those listings, and we use a few different databases for those. Accountants, attorneys, everybody knows somebody. Most of those don't pan out, so you have to be suspicious of that, or at least expect that you're not going to close something on those recommendations. But you have to kind of cull these things together and just keep going through them. And like I said, I'll look through all these prospectuses every week, and you can just tell if it's something that's going to fit or not. But I'm not averse to buying from a broker. We've done it. Mm-hmm. It's just that you have to look everywhere. And the ones that are listed on the internet, everybody's typed in businesses for sale in Spokane or whatever. Those are ones that's usually been kind of passed around a little bit, and they're not really that marketable. Either the price is wrong or it's not set up for a transition. And that's another part of this too, which we can get into, is understand what you're buying, because do you want to be an operator, or are there people that can run it? Owner-operator models are really tough, because unless you want to be the technical person running the equipment, you got to make sure there's a succession plan in place so you don't buy it and all of a sudden you have no employees.
Yeah, that's a key element. Anything that I've looked at, if they don't have someone on the team that knows the technical side, we can't do it, because it's going to take us 20 years or 30 years for us to know as much as these guys know about how to run this business. And at that point, it's going to be too late. So having management set up early on in the process, as soon as you can, getting that key person that can help take over that organization is really, really critical. That was one of the things that the sellers did on one of the companies we purchased up in Rathdrum. They brought on Nathan, and Nathan had worked in the business for 10 years, I think. I may be getting that wrong, but around 10 years-ish. And then left, started working for another organization. They hired him back and said, hey, we're in the process. We want to sell this company. They reached out to him and said, we want to sell this company. We need you back here to help deal with the succession plan, because we need somebody with the knowledge, industry knowledge, and we trust you, and we know that you can make this happen. So they presented that, and then they also included an employment agreement, and which is, I would get a little bit nervous in general, but it ended up working out really well for us. They ended up having a 2-year employment. I think it was 1 year, 2-year employment agreement. Was it one? 2-year employment agreement that he would stay there as long as we treated him right and everything else, to help us with the transition, which was amazing. He knew the ins and outs of the entire business, and was out within, I think it was 3 weeks, we were able to have the sellers exit the business, because he had so much knowledge about the ins and outs of the everyday. And if they didn't have that set up, it would have been a totally different story. And them being able to move on would have taken much, much longer. And I don't know for you if it's the same, but when you take over a company purchase, and so if you're selling a company, I would really focus on that and not focus on trying to be the person to transition, because I think that from my experience, they've been very uncomfortable with the changes. Like, oh, you're going to use a new payroll company? Oh, you're going to use a different email? Oh, like they just get stressed out about some of the little things that you're updating and stuff. And it's like, it's still the same company. We're selling the same stuff, same part, same service. But we're just, starting to make some of those updates, and it can be difficult for the seller if they've spent 30 years doing it their way. One of the companies we bought, they had a ledger. Everything was in and out ledger, written ledger. They didn't use QuickBooks. So that was, moving to an online platform was kind of a struggle. So anyways, what would be, a lot of people ask me, should I do a franchise, or should I do, a small business purchase, or should I work within and try to take on a management or take on an ownership position? What are your thoughts about that?
I think it depends on the person. The hydroseed business is a good example. That's a great business if somebody wanted to kind of enjoy a part of their life and work for a small business. That's a perfect business for someone to go in and just go in the office and help out and everything. If your goal is to scale beyond that, you're not going to be there every day. So make sure you have somebody that can do that job. So it just depends on really what you're interested in, what you're trying to build. If you're one of the businesses we looked at, it was sold before we got into it, and the owner was the buyer was coming from California. He was going to school to train to replace the owner. It's a wire EDM shop, which is a type of machining technology, and at the 11th hour he pulled out. So he had committed himself. The owner was down the road, and so he was pretty concerned. We ended up stepping in, and we bought it, and it's one of our best companies now. The owner actually was going to retire after a year, but we have these great benefits, and we have this plan in place, and he actually stayed on. He's still there part-time, and he loves working there. It keeps him out of the house. His wife doesn't have to see him every day, so he still gets into play, and it's been a great solution for us. But I think it just depends on what you want to do. So if I wanted to be a furniture builder, maybe I'd go in and buy a furniture company and learn how to make that stuff. But I don't think anybody wants to sit on anything I built, so I'll keep doing this for now.
Awesome. Well, what I would like to do is give you guys an opportunity. Again, this event is for you, and so we want you to have an opportunity to ask some questions. Adam is a wealth of knowledge. I'm very impressed with what they've done, and so I want to give you guys an opportunity to ask some questions. If you're interested in buying or selling, or you have questions about how private equity works or hedge funds or any of that stuff, I think he can probably answer some questions. Go ahead.
What do you use as kind of your guidelines for how long it should take from when you start taking over the business to when it should start turning profitable for you, and measuring just kind of that risk? And I don't know, any thoughts that you have on the time that it should take an investment before it starts to pay off for you and your company?
Yeah, so all of our companies are immediately accretive, so they generate cash flow immediately. We typically, to get into the math of it a little bit, I would say our good rule of thumb when we talked about valuation is 4 times EBITDA is probably the average number out there. And EBITDA, you can use operating income as a proxy as well. And if you take the inverse of that, that's a 25% yield, right? So if you look at the world today, interest rates are sub 2%, dividends are 2%, sub 2%. Even junk bonds trade at 6-7%. Real estate with low interest rates trades low. So there's a real good yield opportunity there. But for us, establishing that margin of safety to make sure that if it's a cyclical company, for example, someone that cycles down in a certain season, we want to make sure we make enough. And hydroseeding is a great example. Hydroseeding is very, very busy in the warmer months and not in the colder months, but we want to keep people retained. So we have people on staff through the winter not doing a whole lot, because we know that when it cycles up, we do well enough to weather that storm. So I would say model out the cash flows, understand the cycle, and make sure where it's deficient or where it doesn't meet your expectation, you have the capital to shore it up, or in the good times you can, put those nuts away so that when it does go bad, you can keep investing or build back off of that. But we're a value investor, so venture capital or angel investing, we don't look for home runs. What we look for is getting on base. So somebody's described our strategy as the money ball of investing. All we want to do is hit singles all day long. Sometimes you hit home runs, but we're not counting on this stuff tripling, doubling, quadrupling. We're not going to sell them anyway. So if we can have the next 20 years of success, our yield on our costs with just the inflation and just general business cycle will start to get pretty big.
That's awesome. One of the things that you just mentioned was that you are looking for companies. You just mentioned that the companies typically day one are positive cash flow. And a lot of people are thinking that people that buy companies are just buying distressed companies, but that's not the case for you in general. Do you have advice to the group or whatnot about companies that are failing versus companies that are successful, that are positive cash flow, or companies that are running negative? Could you talk about that?
Yeah, again, to get a little more technical, we buy cyclical companies based on their balance sheets, and we buy secular companies based on their income statements. And what I mean by that is when you're buying a company that experiences those cycles, what you want to do is make sure that the balance sheet can weather that storm. You don't want a lot of leverage sitting on there. You don't want to get a bunch of capital calls or hit a liquidity crunch, right? So make sure the balance sheet can weather the storm under the most dire circumstances. So don't carry, you want half your balance sheet to be inventory. Why is it the case? We'll find things like that with some companies where owners just said, well, I just buy what I buy. Like we had one owner, he buys something at the beginning of the year, he buys all his inventory and then works it off. It's like,
I saved a couple bucks.
Yeah, you don't have to do that. And then on the income statement, if it's more secular, you should still pay attention to the balance sheet. But if you've got a nice margin there that's coming in consistently, your balance sheet doesn't need to protect you as much. So again, this kind of gets in the weeds a little bit, but just know the business you're buying, because if you're looking at an industrial company or versus a software company, completely different businesses with completely different margin profiles with completely different cycles.
Yeah.
Adam, it's impressive what you've done, but how did you get started? So you went from a very big business equity company to kind of small businesses here in Spokane. How did that kind of all evolve and get started?
Yeah, so when I came back to Spokane, I was still doing a lot of analyst work of value. I worked with a couple startups here. I was the CFO for a couple startups, and it was the same practice. I'm going through their financials, making sure they won't run out of money, always fretting about the clients paying and everything. And I got to tell you, like all that stress all the time kind of made me realize what I didn't want to do. And, working for a big company in Boston, there are nights I'd lay awake because I have a 15% position in a stock that, could go down 30% the next day, and it happened. And it doesn't make any sense. It's not fundamentally driven. It's just, panic selling or whatever. That's not the lifestyle I wanted to live. So when I came back here, it was really just a process of figuring out what I didn't want to do. And then I'll be honest with you, the idea I had came from the business, the House of Hose. Does anybody know that business in Spokane?
Mm-hmm. Yep.
The House of Hose is a phenomenal business, in my opinion. They have figured out how to sell something that you can't just throw on the internet, and they specialize in a very niche product. They've been around forever. They're very quiet. Most investors, I find, this day and age, focus on the bright and shiny things. I like focusing on the things people don't look at, right? Because oftentimes those are where the value is in addition to making money. So for me, I thought, boy, if I could just find more of these types of businesses, and growing up, I remember these businesses, and if we could find those, and now it's a great time because so many businesses are owned by people thinking about the next step, and they're trying to figure out who to entrust these businesses with. So finding that market and just taking a leap. So what happened was I actually talked to some former partners of mine out in Boston, and I said, I'm thinking about doing this. They said, that's genius. Nobody's doing this because we're focusing on markets that people ignore. We're we all know this. If someone from New York, Boston, LA comes into some of these shops and tries to buy their business, they're going to hear the shotgun rack as they're leaving the door. And having, I spent all my time under cars in high school, and I spent my time in shops, and I from here, you really have to, talk to them about the community component, because it's really important, and that resonates in the transaction. So that's kind of how I got started. And to be honest, just being honest, doing the right thing. We talked about moral compass at the table earlier, and being honest with people about their business. And there are great owners we've talked to we haven't pursued a transaction with because it just didn't fit our style. We don't try to lie to them. We tell them exactly what we think, and tell them why it's not a good fit for us. But I think just having that strategy and having that process has really helped us kind of develop the process further. And that's basically how I got started.
Nathan.
How are you finding the businesses that you're purchasing, and why Palindrome?
So the question was, how do you find the businesses you're purchasing, and why the name?
So again, word of mouth, reputation. We started off. I actually know we actually know a mutual broker in town that we started working with. A guy named Scott Martin. He's an accountant in Spokane, and he was an investor in a hedge fund I ran before, actually. And he said, you should really look at some of these businesses. So we looked at one, and we liked it. So I would say right now it's coming from a lot of word of mouth. So the 2 deals we have on the table right now, one came from someone I met through someone else, and we have been talking for the last 2 years. So we're pretty patient. We'll wait a long time for the right deals to come along. The other deal, we actually almost transacted a year ago, but with COVID and everything, we decided to put everything on pause, and now we're going through with it. So it's all been mostly word of mouth at this point. I would say that's been our most fruitful source of deal flow, but we use some platforms where we can get. I made an offer on a company a month ago in Hawaii. It was an HVAC services company, and the owner really liked what we were talking about. And in the 11th hour, a local competitor actually stepped in and wanted to buy it, which is great for him because it's probably a better fit. But I've probably written 15 LOIs in the last few years, and we've closed on almost 2/3 of those. So we don't write very many offers at all. Why Palindrome? I like words, and the metaphor. It's cheesy. I was telling the marketing person that works with us. I said, if I was cheesy, I'd put something on the site that said whether the market's moving backwards or forwards, we're still the same. Because that's exactly who we are. We don't change our stripes at all. We're pretty straightforward. We have the same process, but I like the metaphor there with Palindrome.
Very cool. Rich.
Yeah, we actually started an LP, a limited partnership, and we raised some money, and it was more of a private equity model, and I quickly did not like it for a lot of reasons. One is it's very expensive. The fees when you register through the SEC or through the state are pretty excessive. We spent $35,000 auditing the fund, and we spent $20,000 on an admin. And then you pour a fee on top of that, you're really hurting the investor on day one. So what we decided to do is we bought the fund back from our investors, refunded them all the fees that they had paid. And so the model we have now is we try to finance a lot of this on our own, but we do take on some capital partners, but we don't charge any fees. And we have a nice fixed model for people that are missing income in their portfolio today, because when I was a kid, it was not uncommon for people to collect 8 to 9% in their portfolio with a mix between bonds and treasuries. And so you retire thinking, I'll collect 8% for that. That's impossible now. So you have to rely on, 2% yields and to be honest, speculate on a lot of capital appreciation. There is probably not a person in here that doesn't think that the market will continue to go up. And I actually don't disagree with you. I think, the public markets are facing not only a lot of speculation, but when you think about it, the number of investors that we have in the world investing in public markets today has eclipsed the number of assets for sale. So, people in other countries are buying in Google. So, if Google's trading at 35 times earnings, you're like, if I buy it, it's 35.1, that's fine. It just keeps going up. So the number of publicly traded companies in the U.S. has decreased by half in the last 15 years, but the number of global investors has expanded, tenfold. So it's kind of set up for a supply-demand equation now But again, I don't sleep when relying on speculation.
That's good.
What do your capital partners usually see in their ROI?
So the question is, what do your capital partners typically see in an ROI?
Yeah, we right now I think we're high single digits on what we give them back. It's a fixed payment. We also do we have an optional kicker at the end that we'll pay if the fundamental performance of the company achieves a certain number. So I would say very high single digits has been kind of the number we're at. And one problem with this on alternative investments on private stuff is liquidity, because people put their money in and you're stuck, right? And the nice thing about a stock is you buy it in the morning and sell it in the afternoon. So we actually put and call provisions on our offerings now too, such that after 3 years, if an investor says, I'm getting older in life, I appreciate the return, but I want my money back, they can start putting it back to us early. So that's something we started doing.
Are you actively looking for capital investment?
The question was, are you actively looking for capital investment?
We have an offering out there right now, and we have some capital partners that we're working with. Actually, my colleague over here, Tony, is responsible for all that. I should say for a moment, outside of the culture for other companies, one thing that's really helped me, we talked about delegating earlier and working with good people. I could not do this without the people we have at Palindrome right now. We've got some great CPAs on staff. We've got bookkeeper, marketing people, and Tony ran an investment management firm for 2 decades. And he's one of the few people in Spokane that's actually worked in institutional money. So it's phenomenal having resources to work with that are, to be honest. I tell people my job is to figure out I'm engineering my way out of a job every single day I work, and having these people have really helped. But yes, we have an active offering right now for some deals we're working on.
Are you requiring accredited investors for that?
Our attorney wants us to stick to that. We have room for unaccredited, but it gets a little dicey, so we try to stick to the accredited crowd.
Okay. So, Patrick.
What's the range of the businesses you're looking at? $1 million to $10 million? What would you say?
The question is, what's the range of businesses that you're looking at as far as size-wise, between 1 and 10 million?
It depends. We've moved up the chain a little bit on that side of the equation. What we typically look for now is a core strategy that probably leans to the higher side of that, so it can be 10 to 20 million. But we're not averse to buying some smaller pieces that we can put as a tuck-in strategy. That affords us the ability to buy some owner-operator models and fold them in if the seller thinks that our philosophies are aligned and actually likes it. So it actually has worked. We're actually working on a transaction right now where we're actually tucking in those companies, and we're going from these disparate companies out there to one bigger company, which comes with a lot of economic synergies, but also on the benefits side. We have, after we're all done here, we'll have, 150 employees or so on this. That allows you to do things like start negotiating with insurance companies on your medical plans. So, and that's, for us, that's the number one thing is, it costs us basis points in margin, but, giving people benefits has been huge for us. I don't think we've lost, voluntarily, we haven't lost one employee since, maybe one part-time employee at the Hydro Cedar a year ago, but other than that, we've kept everyone.
Awesome. Very cool. We got time for maybe 1 or 2 more questions?
If someone needs to finance a business acquisition, what do you recommend?
If someone needs to finance a business acquisition, who would you recommend, or what would you recommend?
Yeah, the SBA programs are phenomenal for people. I know that a lot of people, you guys avail yourself of SBA quite a bit. Friends and family, depending on the size of the business and depending on your level of acumen, you obviously don't want to borrow money from friends and family only to have it fail. So I would say SBA program or friends and family is a good place to start. And if you have a more structured approach, going to a broader market and maybe seeking bigger pools of capital would work for you.
Awesome. One more question? Any other questions? No? Oh, Grant.
What's the average close on a deal?
So is that average length of time?
Yeah.
So the question is what's the average length of time it takes to close?
We're really slow, 6 months.
Yeah.
We'll take our time. We spend a lot of time. We thrive on tedium.
Awesome. All right. Well, let's give them applause.
Thank you.
Thank you.